Namaste traders, welcome to Quantsapp. My name is Varun and tomorrow we have our budget day. So a lot of traders are interested to know how we can capitalize on this particular scenario or how we can trade tomorrow. So let us see what we know, let us see what we do not know, and let us see how we can analyze the market today on an EOD basis to prepare for tomorrow. So if you are looking for a crash course on how to trade on such events, this video is for you, because within 15 minutes you can set a timer. Within 15 minutes we are going to learn how you can trade on events like these. Okay, so let us start. Now starting with what we do know. So we know that during events, implied volatilities tend to spike up. What do I mean by implied volatilities? I will explain. So all you have to do is just go to Quantsapp. So this is web.quantsapp.com. If you're on any mobile platform, you can just click in the link in the description. It will be in the first link of the description, and you all can download it for your own device as well. Okay. So just go to the search option, or you can go to the track option, and you can just search for chart. So if you just search for chart, you will find IV chart. So at the bottom, you can see there is IV chart. Now, what exactly do you mean by implied volatility? So implied volatility is nothing but expected momentum. If I just show you in simple terms. So it is the expectation of momentum based on option writers. So what exactly the option writers are expecting with momentum is defined by implied volatility. Okay. Now, whenever we have uncertain events such as budget, we do not know whether the budget will have a positive impact on the market or whether it will have a negative impact on the market. In that case, if there is a positive effect, we know one thing for sure, that the market will move up with a nice speed. And in case if there is a negative effect of budget, then we know that the market will fall with a higher speed, a relatively higher speed. So during such events, we know that market tends to experience higher than usual momentum. So in terms of expected momentum, we know that option writers will be prepared for this, because option writers' biggest enemy is market direction or the momentum of the market, right? So you can picture it this way. If I am selling call and put, let's say if I'm selling an at the money call as well as an at the money put, or if I'm selling a straddle, in that case, if the market moves exponentially in either direction, in that case, I am bound to make losses there. So what do these writers do? These writers inflate the premiums. So these writers already inflate the premiums, in the sense that if there is a momentum in the market or a higher than usual momentum in the market, in that sense, their break even is pushed further away from the current market price, and they have a wider range overall, right? So I know that this might be a little confusing, but in simple terms, if I am an option writer, if I am expecting a higher momentum, that means I have higher chances of losing in that trade. So in that case, I will always take higher premiums or charge higher premiums. So implied volatility in simple terms has a direct correlation with the options premium. So if implied volatility increases, then we know that overall premiums inside the option chain will start going up. If implied volatility falls down, then in that case, I know that premiums overall are about to fall down or decrease. Okay. Now currently, if we just look at the IV chart, this is the IV chart of Nifty. So the blue line that you can see, that is Nifty's future price. The white highlighted line with a gradient is basically implied volatility, right? So you can see that implied volatility has spiked up as of now. If I just zoom in a little bit, okay, I'll just zoom in a little bit. All right, I cannot zoom. Okay, that is fine. That is fine. I can just showcase you right here. Okay. Now this was the day of our election. So last month we had 4th of June when we had our election results. I can see that IV is 27.54, and overall you can see that implied volatility was at its peak, right? So after that, once the event was over, or on 5th of June, we could see that implied volatility experienced a very sharp fall. So from 27 it came to 17. So similar thing we can expect now as well. Currently implied volatility is at 23.78, and we can see that implied volatility is right here. This is the current stage of implied volatility, which is almost higher than all of the days expect for budget. Sorry, not the budget, election. So aside from the election date, all of the days we've seen have a lower implied volatility than the current implied volatility. So this means that implied volatility is starting to go at its peak. Now, once the budget is finalized, or once we know what the budget is, the event is done. What do you expect will happen with implied volatilities? Implied volatilities will fall down. So in this case, it is very risky to go for any option buying heavy trade. Why? Because a lot of times market goes in your favor, but the premium of that particular option which you have bought does not increase due to this factor. So this is something that a lot of traders who are new to the market do not consider. That is why I thought about explaining this first. Okay. So implied volatility is a direct impact on your extrinsic value of the premium, right? Now, how do you trade this? So the only way of trading this is with the help of a writing heavy strategy. So let's understand what a writing heavy strategy is. Now we are slowly moving towards the what we do not know part. So we know that implied volatility plays a major role during such events. We know the behavior of implied volatility. We know that implied volatility tends to rise up before event, and implied volatility tends to subdue itself after the event, right? So that is generally what we know of. Now, do we know whether the market will move up? If it will, how many points? Do we know that the market will fall down? Or if it does, how many points? We do not know these things. So in that case, we can at least try to predict what is about to happen, or we can at least try to see what the writers are expecting with the market overall. Okay. So all in all, we know that the writers are expecting a slightly higher momentum, but what are the levels that the writers are expecting for the current expiry, which is also the monthly expiry? So for that, you can just go to the track section. You can open the open interest tool. So this is options open interest. So this is the options open interest tool. Okay, I'll just zoom in a little bit so that you all have a very good view of it. We can see that there are some green bars, there are some red bars. So the green bars I'll call open interest, red bars are put open interest. So above side you can see it is call OTM, below you can see this is put OTM. Okay, so these are all the strikes. Now I can see that the biggest green bar is this particular bar. It is 25,500 strike. So I know that major call buildup is on 25,500 strike. So the call writers are expecting if the market does go up, it will not go up beyond 25,500, or it will expire somewhere near that range. All right. If the market does fall down, this is the biggest red bar. So 24,000 is the level that you can see. So if the writers are expecting, the put writers namely are expecting that if the market does fall down, it will not fall beyond this level. So open interest levels based on this, or the heaviest call and the heaviest put, acts as a resistance and support respectively. So the heaviest call would be your resistance or your ceiling, and the heaviest put will be your support or the floor. So market tends to expire between this range. Now, generally when we have just 3 days left to expire, we do not see such a wide range. Why? Because within 3 days, it is very difficult for an index to move that much. But we know since there is budget tomorrow, market is about to experience a higher than usual momentum. Hence, you can see that the writers are also hesitant to write near the at the money strike. Right? So this is something that I have generally seen. Now, even if you look at charts as well, let's look at the budget of each year historically. So I'll just go to the analyze section. Okay. Under analyze section, you can go to charts. So you'll find charts, order and trade. I'll just get rid of all of the indicators. Okay. And I'll add a 1 minute, 1 day chart. Okay. So this is a 1 day chart of Nifty. I'll just go to the previous budget, which was 2023 Feb 1st. So we know that every year on 1st of February, it's budget day. So I'll just click on that. I can see that Nifty has moved up quite a bit on this particular day. So if I just place my cursor here, I can see that Nifty has moved down by around 121 points. This is good. All right. Let's check 1 year prior. So 2022 Feb 1st. Okay. 1st Feb 2022. Now here I can see that Nifty has moved up by around 227 points. This is also good. So around 1.3%. All right. Let's go to 1 year prior to that, just 2021. All right. So I'll just click on it. 2021, Feb 1st. Okay. Here I can see Nifty has moved up by around 642 points. Now this is what I call a very good move, which can make sure that writers do not make money or they lose money. So these are the things that we need to stay away from or at least be aware of. Okay. So currently we need to consider a couple of things when we are trying to write options with a range. Now we do not know whether market will give you a move of above 4% or whether it will give you a move below 1%. We do not know that. But at least there are a couple of things which we can use to consider the range that we are forecasting for tomorrow or maybe for the expiry. So let us see exactly that. So for that, what you can do is you can directly open Quantsapp's own option writer tool. So just go to the trading section. It is our own quant model which helps you in identifying a range or forecasting a range. So under quant models, you will find there is option writer right here. So just click on option writer. So I'll explain a couple different methods to identify the range of the market. All right. So here what you can do is you can select the range that you want. So all you have to do is just go and select a script that you want. Okay. Select the expiry and select the number of days that you want to sell for. Right. So let's say if I want to sell for tomorrow, right? If I just set it to 0, that means it is an intraday strategy. But since today the market has actually ended, so I can see that it is already showing me tomorrow's range. Okay. You can also drag it all the way till expiry or maybe a day before expiry or something like that. Let me just keep it for a day before expiry. Nothing too long or nothing too short. All right. Here there are multiple ranges. So just click on the range indicator. You can search based on IV range. You can also search based on heaviest OI call and put. Now let's say I want to select the IV range. So IV range is calculated based on the current implied volatilities. So it's a realistic depiction of what the writers are expecting with the momentum of the market. So here if we look at the chart, I can see that the writers are expecting a 4% move, 4.15% move in the next 2 days or a 1,000-point move. So this is what based on implied volatilities the writers are expecting. Right? So this is something that you can consider as well. But I feel like, this is a very realistic expectation of the market. All right. Now, based on this, what should you sell? So I can see that these are my upper bounds and lower bounds. If I just go to the settings, right, this is the range. So the writers are expecting based on implied volatility, they are expecting that the market will not exceed the level of 25.36 or it will not fall beyond 23,997. This is the realistic expectation based on implied volatilities. Normally, what would a layman do? If I was a layman, I would go and sell 25,050 call option and 23,000 or 23,950, something like that, put option. This is something that I would do based on this range, just one strike above, one strike below. But that is not always accurate or even suggested. So what I would do is I would look at option writer. So the option writer, you can look, it is suggesting that you sell 24,550 call option and 24,500 put option. Currently the market is at 24,517. So it is almost suggesting a straddle for you. Now why does it do that? Because you can see the break evens. So these break evens are pretty much near the upper and lower bound of this forecasted range. So that is why you need to consider break evens that not a lot of traders do, but the model will do it for you, and based on that you can calculate what is going on here, right? So this is basically what you can go for. Or if you want to play it even safer, then in that case what you can do is go to range indicator, search for heaviest OI call and put. Now, based on heaviest OI call and put, it's a 1500 point range. We already saw that, based on it, if I just click on settings, this is the range 25,500 and 24,000 based on heaviest call and heaviest put or support and resistance. Based on this, it is suggesting this range. So it is suggesting that you sell a 25,550 call option and 23,950 put option. Why? Because the range is far beyond that the implied volatility is paying you for, since implied volatility is directly impacting your premium, implied volatility is not that high to cover this entire range. So hence it is not suggesting close by strikes, it is suggesting further away strikes so that you are always protected based on it. Here you can see the break evens are also quite good based on this at least, and you can go and sell that. Now personally I do not focus on this. I would generally go for the IV range. So you all can look for it. You can see what you want to do. You all can go for the safer range, or you all can go with the IV range. Now if I was in your place, I would just go to IV range and I would just go and hedge these strikes. Based on the break evens, I could go and hedge these strikes. Now I know if the market falls beyond 24,140, I could lose. And if the market goes beyond 24,900, I could lose as well. So I'll just go and add a hedge. So I'll maybe buy 24,150 put option and 24,900 call option. So I'll just go and add that. Okay, so 24,900 call option I will buy and 24,150 put option I will buy. Now this is effectively what I've done. I've converted it into a sort of like a butterfly, or more realistically it is a short iron condor. This is what I have created, and you can see that the break evens now are slightly narrower, but at least I do not have the risk of undefined losses. So this is something that you all can do on your own as well. This is something that a lot of traders do, and I would personally suggest, if you are going for a selling heavy strategy, hedging the strategy is a must. All right. Now what about exits? So how do you exit? So for exit, we have our own trailing methods. So if I just click on execute, it will bring up a trade management feature. So this is your profit, right? You can see the profit here as well as your stop loss. So you all can set the profit and stop loss accordingly, whatever you want. This is the suggested profit, target profit, and this is the suggested stop loss accordingly. You can see that. And it can also trail on its own. So this is an alert system that we have. If you achieve your target profit, you get an alert on your Quantsapp mobile app or Telegram if you have mapped it. If your stop loss is hit, then you will set an alert for that as well. And if trailing profit alert is there, then you will also trigger that alert. So either of these alerts, if they ring on your phone, you have to go and square off the position anyways. So this is something that you all can do. So it does not just actually save your profits. It also tries to actually indicate when the exact point of exit is. So that is something that you all can use on that day. So this is something that I have faced a lot of problems with, timely exits. So this is where the Quantsapp's indicator and the alert system will shine for you. All right. So my name is Varun again. I hope you all enjoyed. This is it. You all can see within 15 minutes, you have learned everything that you need to learn about the budget day. Thank you so much for it. Thank you so much for giving me your valuable time. All the best for tomorrow, and I will see you guys very soon in the next video. Thank you so much.